globally, the economic data has been ridiculously bad, right? I mean, Germany recently, the UK with inflation, Japan with inflation. We know China's struggling, their economy's struggling. And so, what's kind of intriguing to me is that the dollar's not getting a bigger bid, considering that the economic data here has been really actually pretty good comparatively. So it's almost like, okay, so if that's not giving the dollar a bid, does that potentially mean that when the US economy starts to weaken, which, whether it's in 3 months, 6 months, a year, at some point it will, does that then mean, do we have a bigger rollover? And again, it is kind of interesting with the chatter about de-dollarization. Janet Yellen recently saying that, people should actually diversify away from US dollars a little bit, because it probably won't be the only currency out there.
During a congressional hearing in June, the Treasury Secretary Janet Yellen offered her opinion on the subject of the so-called de-dollarization, asserting that no currency now exists that could replace the dollar, despite the fact that US sanctions and foreign policy moves have sparked a backlash from China, Russia, and other important countries that are eager to support the dollar. Yellen is unwavering in her belief that no nation will be able to easily find a means to circumvent the currency. She did, however, issue a warning that as nations seek to diversify, the percentage of global reserves held in the US dollar may continue to fall. In June, the industrial sector in Germany shrank at its fastest rate in more than 3 years, according to a poll released on Monday. Since July 2022, the manufacturing NI has been below the threshold of 50 that distinguishes expansion from contractions. Overall, the PMI numbers for manufacturing indicate that a recession in this industry, which was still expanding in the first quarter according to GDP statistics, has grown far more likely, according to De La Rubia. The growing wall of fear in the stock market and property market is a topic Gareth Soloway discusses in this video. While all of this is going on, he also discusses the Fed, inflation, and Bitcoin's domination. Now let's watch the video with Soloway. Please remember to like, subscribe, and leave your comments as well.
Economic data globally has been really, really weak. You'd assume the dollar would be ripping right now.
Right. It hasn't so far.
Yeah, although I will say this, is that we know the US dollar does well when there's panic, right? When there's panic. And if you look at the VIX, and in fact, I'll pop up the VIX here, it's anything but panic. And I mean, you have riots in France right now. You have, there's lots of stuff that you could argue, hey, this should be causing some sort of move in the volatility index and fear. And it's just not. And I was curious about your thoughts on that. I mean, why when we have the potential for, higher rates from the Fed said maybe 2 more rate hikes this year, markets didn't flinch. We see riots in France, granted that's probably not, you had that potential coup in Russia, markets didn't flinch, granted it was pretty much over, but why is that? And one of the charts I want to show here is mortgage originations by age. And again, the age is almost irrelevant to me. I'm just more focusing on massive amount of mortgages taken here, which was good because interest rates were really, really low. But one of the things, and this is always the rebuttal I get, well, if people got these loans at 3%, they're not walking away from them. But at the same time, I think people aren't taking into account the fact that inflation has skyrocketed, right? So you have to look at what these people now are paying for food, energy, all these other things, in addition to their home price or their mortgage payment. You also talk about if the labor market starts to crack. I mean, how much of this comes back to roost? And do we see a wave of people saying, yeah, well, I took a mortgage at 3%, but if you can't pay your 3% mortgage anyways, what ends up happening? There's this common kind of thought process with investors where it's like the cheaper it is, the better value it must be. And I do think people need to recognize that that's not always the case. You can play them for bounces, but valuation will have to figure itself out as we get regulation in here. And to be honest, it's very hard to figure out what the valuation of a Matic or a Cardano would be. If I flip just to the Cardano chart, I'll show you guys here. Bear with me as I bring that up. So basically, Cardano still hasn't broken out. Matic's starting to peak above the level here, but you can see that, again, Cardano is still up into this resistance, which is right around 30 cents. If it gets through 30 cents, you should head to about 33 cents, that longer term down sloping trend line. So yeah, it's kind of interesting to view. And again, I'm a much shorter term trader, so just kind of taking advantage of these little moves and so forth. To be honest, I think Bitcoin dominance is still going higher. I know you're in the same thought process of that. And I think what investors need to recognize is that last week we got the SEC to say that the Bitcoin ETF filings for the spot were inadequate, and so just naturally that's going to make Bitcoin investors a little bit more hesitant. And then I also think you have a lot of speculation. I mean, just going back to the stock market and tying the stock market in right now, the stock market has been so strong, like every day floating up, floating up, floating up, that eventually what people do is when everything, like you're looking at some of these stocks that have just gone parabolic, they start to look for what hasn't run. And so I think there's just this natural thing of saying, oh, well, these altcoins are so low, I'm just going to give it a shot, which just creates that little bit of a bounce. So you have the negative of Bitcoin with the SEC, even though it wasn't that big of a deal, saying that the ETFs were inadequate. And then you have this kind of risk on kind of thought process where you're then pushing the alts up a little bit. So at least for me, that's kind of where I am at.
At least one indicator shows that the U.S. stock market has declined since the year's beginning. According to information from Refinitiv, the S&P 500 Equal Weight Index, which assigns each stock an equal weight, has decreased by 0.35% since January. That contrasts sharply with the benchmark S&P 500's 9.5% gain, wherein a larger proportion of the index is made up of companies with higher market capitalizations. There has never been such a severe negative divergence, according to Manfred Hubner, managing director at research firm Centix, despite larger differences between the two gauges of the same stock market's performance having previously emerged. The discrepancy is due to the rise in demand for the largest stocks. According to AJ Bell's broadcast, Nvidia, Microsoft, Apple, Amazon, and Meta have added a combined $3.1 trillion to their market caps since 2023. Without taking into account their contribution, the S&P 500 has lost $286 billion so far this year. Now let's return to the video and watch as Gareth discusses housing, S&P divergence, and the price movement of Bitcoin.
It's pretty remarkable, the crypto sentiment right now, specifically in regards to Bitcoin. It seems like anyone that was on the alt train has now moved into the Bitcoin train, and it's pretty wild out there right now in terms of bullish sentiment. And I would say, so I see a question here about, I talked previously, over the last year, that Bitcoin could potentially decline by as much as 85%. That data point came from past cycles about how much it dropped in each of the past cycles. It was somewhere around that. I actually think that it also has to do with how much of a decline we saw in Amazon. If this was the .com bubble bursting in crypto, it was also looking at Amazon as being kind of the child of the .com bubble, and Bitcoin obviously being the one for crypto. And so if you look back at Amazon back in 01, it bottomed out down about 85+% when all was said and done. So I have a chart here of excess household savings, and we can see that you had this massive increase in savings in the COVID right in that beginning portion of COVID, and still it's coming down, but it's still working its way through, right? It hasn't, because people had so much savings, they're able to withstand and still continue to kind of buy things. But the other question then becomes is, as inflation continues to take its toll, does that then weaken the consumer even more? But yeah, interesting chart there showing the surge in savings and then kind of the fade on it as it's coming back in here. Just based on purely the S&P chart, what we have here is you can see this upsloping trend line that actually goes all the way back to the COVID low. So if you take that low and you run it right through here to these highs, and it matches basically perfectly with these highs, we actually kissed that high right here before the latest pullback in the S&P, which was about a one week long pullback. And then what we're seeing here is we're rising again towards that same trend line. So I would expect that trend line, if we hit it, let's say later this week, it's not that much higher. I think it's about 20 to 30 points higher on the S&P 500. That'll be your next big resistance level. But again, for me, it's kind of looking at this, and I don't know if you have a chart on this, and maybe I should have given you a heads up, but I was wondering if you had the S&P 500 minus the top 7, the Googles, the Apples, the Microsofts, the Nvidias, and I would just be fascinating to look at this year, what's the actual return on the S&P if you take out 7 stocks? And I could be wrong on this, but I think the return is probably in the range of 3%. What I'm showing here, guys, is this is the tech stock sentiment. And so the last time we were this high on tech stocks was in the .com bubble. And so you basically, now there you were higher. It did go higher than that quite a bit when the dot-com bubble hit. But just interesting to see that we have not been that high going all the way back to the dot-coms. And the one thing I would just say in regards to these big cap tech is that they have become so mammoth in terms of their market cap relative to the rest of the market that now you have the NASDAQ 100, and basically 50% of the NASDAQ is these stocks. The S&P is about 25+%. And so the reason why that's a concern, because when things are good, it's great, right? It takes the whole market up with it. If you're in an index fund, you're doing great. The problem is that if these things correct, and if you look at historical PE ratios, and this is something that a lot of people don't kind of realize because they're newer investors, but when I was growing up in the 2000s to 2010s and I'm just getting into trading, in a recession, the general PE ratio for a large cap tech was 8 to 10. Well, you have Microsoft over 30, Apple at 30. Like, I mean, there's a lot of froth there because these stocks have been utilized as kind of a safe haven, and they've become so dominant that, again, there's a huge risk there. If all of a sudden those stocks come in, the market could go down 20% in a flash.
The Federal Reserve's long-term target for inflation is 2%, and the BOZ Core Personal Consumption Expenditures Price Index for May, which was issued last Friday, shows that core inflation is still significantly higher at 4.6%. The Core Consumer Price Index, or CPI, for May showed an increase of 5.3%. Fed is known to use core PC data as its main inflation indicator. Since monetary policy primarily determines the inflation rate over the long term, the committee is able to set a long-term inflation target. The committee determines that a 2% inflation rate, as measured by the yearly change in the price index for personal consumption expenditures, is the best consistent with the Federal Reserve's statutory mandate over the longer term. By making this inflation goal clear to the public, the committee is better able to promote maximum employment in the face of significant economic disruptions, and to keep longer-term inflation expectations firmly anchored. In other places, the federal government emphasizes the significance of longer-term inflation trends, the possibility of persistence, and the significance of core inflation, or less food and energy. Why the focus on judicial inflation? What do you believe? Please share your thoughts in the section below. Also, don't forget to click the like button, subscribe, and enable notifications for additional videos. Thank you for watching.